The Federal Reserve has just held the Fed funds rate and forecast fewer rate cuts this year, as expected. But global stocks and bonds held on to their price gains and lower yields made before the FOMC's decision. That was because US inflation in May was softer than expected. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes says Asia's heatwave is putting huge pressure on energy grids, already dealing with greater electrification. And that's boosting demand for LNG.
It's not like LNG producers can suddenly provide additional cargoes at the blink of an eye. So there's going to be some tightness, and certainly some consumers will have to delve into their inventories.
But first, in 5 and 5 with ANZ, the FOMC has held the Fed's funds rate at 5.25% to 5.5%, but it tweaked its dot plot expectations for where that rate is headed, from a median of 3 25 basis point cuts this year to just 1, while revising up its cuts expected next year from 3 to 4. Earlier, US core CPI in May was just 0.2%. Now, that was lower than the 0.3% expected. That sent US Treasury yields tumbling around 14 basis points. Here's ANZ Head of G3 Economics, Brian Martin, on what the combination of the soft CPI and the Fed's higher dot plot means for inflation and the most important interest rate in the world. He points out the key was the spread in the dots from the voting members. 4 actually saw no cut, 7 saw 1 cut, and 8 saw 2 cuts.
My sense is that when you look at the voting patterns, the committee is not looking for big rate cuts this year. They've definitely scaled back their anticipated cutting, but some 8 members still think that 2 cuts are required. So I think they're just waiting for the data. They just need that bit more confidence. And the CPI numbers today really were very encouraging that the decline in inflation towards target has resumed during the second quarter. And I think if we get a couple more months of data like this, we could well be looking at the Fed cutting in the third quarter of this year.
As of 5 a.m. Sydney-Melbourne time, a weaker US dollar saw the Aussie dollar up 1.1% at 66.84 US cents. The Kiwi was up 1% at 62.04 just after the FOMC decision. Number 2, the Bank of Thailand's committee held rates at 2.5% yesterday, voting 6-1 for the hold, the one less dissenting view than previously. ANZ economist Crystal Tan says while the likelihood of a cut has fallen, there is a risk that legal cases involving senior political figures in the country delay fiscal spending.
We think it's still too soon to rule out a rate cut this year, because if political risks intensify in the coming weeks and disrupt fiscal policy implementation, that would strengthen the case for monetary policy support. Conversely, if political stability prevails and the fiscal boost materializes as per the government's plans, then that would push out a BOT easing pivot into 2025 instead.
Number 3, India's annual CPI inflation rate was 4.75% in May. That was lower than the 4.9% expected because of lower growth in food prices. ANZ economist Dheeraj Nim says core inflation also decelerated slightly to 3.1%.
Now, it does not change the RBI's policy calculus very much in that the food inflation bit is still uncomfortable for the Reserve Bank of India, whereas core inflation will continue to give them comfort. We do think that a rate cut will happen in India, but not before December 2024.
Number 4, China's CPI rose 0.3% from a year ago in May, the same as in April, but slightly below market expectations. Producer prices were down 1.4%. Now, that's less than the 2.5% seen in April. ANZ senior China strategist Xiaopeng Xing says domestic demand remains very weak.
Both CPI and PPI number in May suggest that China is experiencing cost push improvement because PPI improved a lot in May. But the final demand reflected by the very low CPI still point to a very weak final demand. The policy support to the demand side will continue to be a must.
Number 5, Australia's jobs numbers for May are due later today. ANZ Head of Australian Economics Adam Boyton is picking the unemployment rate to fall back to 3.9% from 4.1% in April. The consensus is for 4%.
In the April labour force release, the Bureau of Statistics noted that part of the rise in unemployment that month was due to a larger than normal number of people having a job to go to, but they hadn't just started that job. And so that gets reflected, or they got reflected or counted as unemployed. That should reverse in the May number.
Adam Boyton there. Now, in our bonus deep dive interview, ANZ's senior commodities strategist Daniel Hynes talks with my colleague Alex Tarrant about the pressure on energy markets and Asian power grids from the recent heat waves across the region.
That's certainly putting pressure on markets which are having to deal with, I suppose, this electrification of the world economy over the past 4 or 5 years, where the amount of renewable energy capacity put onto the grid, but more so around converting more direct energy use, which was through the direct burning, I suppose, of coal and gas, to those now feeding through into the electrical system. And the prime example of that is electric vehicles, where previously it was burning petrol or gasoline, and now it's essentially using electricity. And so that electrification of the world economy has been putting pressure on those power markets, which haven't grown in capacity to the same extent. And now we're seeing this extreme weather in Asia result in demand for cooling increasing quite significantly. And we've already seen electricity prices rise across some of the open markets, such as Japan, South Korea and India. China has a more regulated market, but certainly their costs have risen quite significantly. So yeah, it's something which sort of goes a little bit unnoticed. You think energy demand generally tends to be high in the winter months, but that extreme weather can work both ways. And at the moment, we're seeing that through Asia.
And in particular, demand for LNG rising. What's happening in that market?
Yeah, well, I mean, the resultant high temperatures, while should benefit solar generated capacity, tends to rely more heavily on hydro in Asia. And high temperatures have actually come with a relatively low level of rain. So the output from hydros are diminishing. And when the demand occurs, usually at night, people get home, put on the air conditioner. The other sources, wind and solar, aren't available. So it comes way back on the fossil fuels. And certainly LNG is the one key energy source which can meet that additional demand relatively quickly. And so we're seeing buyers, consumers across the region really gobble up any sort of available LNG cargoes at the moment, with forecasts for higher than normal temperatures over the next month, leading to a significant pickup in electricity demand.
How are they going to keep on meeting this demand if LNG keeps on sort of topping out?
Yeah, well, I mean, it's not like LNG producers can suddenly provide, additional cargoes at the blink of an eye. So there's going to be some tightness, and certainly some consumers will have to delve into their inventories. Japan is one where they do have some to access, so the impact there won't be as great. But India is one where, its available sources are relatively low, and that's why we've seen them really active in the market. So look, sometimes it'll mean that some power markets will just have to shut down for periods of time if they can't meet that demand coming through. At the moment, it doesn't look like we'll get to those sort of extreme levels, but it certainly is a risk, I think, that we need to be mindful of.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, June the 12th. Catch you tomorrow with a review of Australia's labour market data and ongoing market reaction to the FOMC decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.